A very good evening and thank you for joining Infosys' fourth quarter financial results. I am Rishi and on behalf of Infosys, I'd like to welcome you to our press conference today. Before we commence, I want to take a moment to mention a few guidelines. Our friends from media, you will be on mute by default throughout the press conference. You will be requested to unmute yourself when we announce you for your question. And we request one question from each journalist so that we can accommodate everyone over the next hour. In case you're disconnected, please rejoin using the same link that was sent to you by our teams. With that, let me invite our Chief Executive Officer, Mr. Salil Parekh, for his opening remarks. Over to you, Salil.
Thanks, Rishi. Good afternoon, everyone, and welcome. Thank you for joining us for this session. I trust you and your families are well and safe. We've had an exceptional year and an exceptional quarter. Our year-on-year constant currency growth was at 9.6% for Q4. And for the full year, our growth was 5% in constant currency. Our digital business grew by 34% year-on-year in Q4, and now representing 51.5% of our overall revenue. On large deal wins, our large deal wins were at 14 billion for the full year, a growth of 57% over the previous financial year, and they were at 2.1 billion for Q4. Within the full year large deals, 66% were net new, helping us to set up a very strong foundation for the next financial year. With these exceptional results, we had industry-leading growth in financial year 21. We continue to gain market share, and I'm grateful for the trust our clients have put in Infosys as we partner with them for their digital transformation programs. Our growth was broad-based, with several of our industry segments showing strong growth year-on-year, and it stems from our market-leading capabilities in digital, cloud, cybersecurity, and in data and analytics, which allow us now to work with our clients' most aspirational digital transformation activities. Our operating margin for FY21 improved by 320 basis points to reach 24.5% for the full year. For the quarter as well, it was at 24.5%. I'm extremely proud of our employees and their enormous commitment, especially during this past year, but in general across the years. We launched our second compensation review in a phased manner starting in July 2021. Our employees and our entire leadership team work cohesively and for the benefit of our clients. This approach, which we call One Infosys, has really enabled us to have a very strong financial year 21 and allowed us to look ahead with success. Now, looking ahead, we see continued strong demand from our clients, especially in digital, in cloud, in data, and we have a strong foundation of large deals. With that, our constant currency full year revenue guidance for financial year 22 is growth between 12% and 14%. For operating margin, our superior performance in financial year 21 was in part because of improvement in several strategic cost levers and in part because of cost avoidance and deferment. With normalcy returning gradually across the world, we anticipate some of those costs to return. With that, our operating margin guidance for the full year financial year 22 is between 22% and 24%. In keeping with our capital allocation policy, we propose an increase to the total dividend per share by 54% over the previous year for a full year dividend at rupees 27. In addition, we propose a buyback of equity shares of up to rupees 9,200 crores, which is approximately $1.2 billion. We will use the open market method for this buyback. Thank you very much. With that, let me pause and let's open it up for questions. Back to you, Rishi.
Thank you, Salil. We now open the floor for questions. With Salil, we have Mr. Praveen Rao, Chief Operating Officer, Infosys, and Mr. Nilanjan Roy, Chief Financial Officer, Infosys. With this, we open with the first question. And the first question is from Sharad Dubey, CNBC Awaaz, who joins us on video. Sharad, please unmute yourself and ask your question. Sharad, you'll have to unmute yourself, please.
I'm audible?
Yeah, please go ahead.
Yeah, I have a question for Salil. So the constant currency growth, if you take it for the fourth quarter itself, it came at almost 2%, and the expectations were almost 3 to 3.5%. So, sir, what can be the reasons, attributable for this, and what goes ahead in the outlook? And one more query I have for Praveen, sir, is the attritions which have actually increased, by almost 5%. It came in at almost 15% for the fourth quarter. So do you expect the numbers in the attritions to increase in FY22? And what will be the hiring outlook looking like?
So let me start with the revenue. I think for the quarter, as you mentioned, the revenue growth was at 2%. We had very strong volume growth at 4.5%. We had a mix move from on-site to offshore, which caused some of the change, and some of the third-party costs which normally come in did not come in Q4. However, our full year growth guidance remains very strong at 12% to 14% for financial year 22. And we continue to see very good demand in what we are seeing from our clients today.
On the attrition front, attrition has increased from 10% to 15.2%. This attrition, annualized attrition of IT services. And this is something we had anticipated, and it's a reflection of the strong demand that we are seeing in the market. Having said that, we are increasing our efforts to retain our talent. We had the first round of compensation increase effective January. We have announced one more round, the normal cycle with effective date of July. And in between, any other interventions that are required to retain some of our best talent, we'll continue to do that. And over the past year also, we have engaged our people. We provide a very strong value proposition in terms of engagement and enablement. There is a lot of focus on continuous learning, a lot of important projects people get to work on. There is a lot of career advancement opportunity and so on. And in the past year or so, during COVID, we have really done extremely well in terms of engaging with people, engaging their families, providing a lot of support. We have had more than 900 plus interventions and so on, and we have received very, very positive feedback. So we are very confident that with these measures, we should be able to navigate through this. The attrition is likely to remain at this level for next 1 or 2 quarters, given the demand. But we are very confident of managing through this and meeting our client commitments.
Thank you, Sharad. The next question is from Sajid Mangat from Bloomberg Quint.
Good evening, gentlemen. Season's greeting to you all. My first question is to Praveen with respect to the guidance which has been given, especially the margins part of it. You entered the year with 24.5% operating margins, and your guidance is in the range of 22 to 24%. What is the kind of headwind that you're seeing in terms of guidance or in terms of margin that has that you've been very conservative in giving a guidance which is much, your upper end is also not matching the full year guidance which you did for this financial year. The second one is with respect to the deal wins, $2.4 billion in Q4. But it seems that your run rate has slowed down in towards the end of Q4. Is it because some of the deals have been pushed to the next financial year? And if you can give some color on the financial services business segment as a whole as well.
Okay, I will start with the large deals and financial services, then I'll pass it on to Nilanjan or Salil to respond on the margin guidance. On the large deals, we had a 25 large deal wins this quarter, $2.1 billion. And for the year, it was 14.1 billion, which is a record in Infosys history. And even in quarter four, 52% of large deal wins was net new. And for the year, it's 66%. And in fact, the net new for the year, 9.4 billion, is higher than all the large deal TCV that we did in whole of FY20. Obviously, this large deal is not something, there is some volatility in terms of large deal because many of the deals take 3 to 6 months for closure. There are times when we are able to close many deals in a given quarter. There are times when it gets pushed out. But we have, given that we have about 14 billion with 66% net new, we have a very, very strong foundation getting into the next year, FY22. So we are pretty comfortable with where we are. In terms of financial services, we had record growth, industry-leading growth in the past few quarters. That continues in this quarter as well. For the year, we had 25 large deal wins in this space. And in this quarter itself, 6 of the wins was in financial services. So we are really well positioned for this sector to continue this strong performance in FY22 as well. And in terms of demand areas, we are seeing, of course, lot of transformational programs around mortgage transformation, lending services, front-to-back digitization, customer experience modernization, then call center technologies and operations transformation, and so on. So we are very, very optimistic about this segment.
So I'll take the margin question. If you see our margins, actually, you have to go back to FY20. And we ended FY20 with 21.3% margin, and we've ended FY21 with 24.5%. So that's a 3.2% margin growth, and that kind of growth we have not seen in the recent past. And like we've told you over the last few quarters as well, that the margin improvement of 320 basis points has come about with 2 or 3 reasons. One, of course, has been the cost deferments, which Salil mentioned. Because last year, of course, we delayed the entire pay cycle, number one. We also had cut back on our promotion cycles. In addition, we had done aggressive cost cutting in things like travel, of course, which naturally had stopped, on marketing, etc. And of course, we also did a lot of work on our strategic cost levers around pyramid and on-site offshore automation. All these 3 helped us during the year to come to the 24.5%. Cost tailwinds, which was about the deferred costs, would come back in the financial year 22. So the first pay hike, which was in January, has been announced. That became a headwind. And of course, as Salil just mentioned, we also now are looking at the second pay from 1st of July. As the year progresses in the second half and the vaccine starts promulgating across, we think travel, etc., will open up. And some of these costs at the tail end will come up. So we think 22 to 24 is a very comfortable range. It's important to keep in mind as well that the pre-pandemic periods on FY20, our guidance was 21 to 23. So now in that sense, we are now 1% higher in the new guidance of 22 to 24. So we remain quite comfortable with that.
Thank you, Sajid. The next question is from Kushal Gupta from Z Business.
Yeah, hello, gentlemen. I have 2 questions. One is with regards to the digital revenue share, considering before last quarter, like in Q3, we saw that it crossed more than 50%. Going forward, like by the end of FY22, what's the what's the deal trajectory we are expecting for digital contracts? How much share could we end up with in FY22? And secondly, would be on the regional front. front, like for example, North America and Europe? How are we seeing that the business shaping up there? Is the second wave, are we done away with that? And the kind of considerations, how is the client spending going to be for FY22 from your IT clients perspective? So these are my two questions.
Thanks. Let me start with the digital one and then come to the geography. And if Praveen may add something on the geography side as well. On digital, we are seeing tremendous growth. We had 34% growth in this quarter four, and we see all of our clients are on different stages of their digital transformation activities. What is good for us is clients are trusting Infosys to work with them in many different parts of the digital transformation. For example, in cloud, data and analytics, in cybersecurity, and many other areas. Given the trajectory of growth we've been seeing recently, and given the demand and the pipeline, we believe this is the sort of growth will continue. We don't have a specific number for the end of the year percentage that digital will be, but we feel comfortable that we are gaining market share and growing quite fast in digital. In terms of geography, the demand in US clients, European clients is strong. What we are seeing is with the vaccine rollouts, the US is already starting to see some resumption of normalcy over the next maybe 3-4 months. And Europe also has progressed quite a lot, and they will come maybe just a little bit after that. UK is also in a good shape from that perspective, with their lockdown being starting to ease as we saw yesterday. And we think that that will also come into good shape with all of the stimulus that each of those governments have provided. Something similar for us in the Asia Pacific business, especially as it relates to Australia, New Zealand, and Singapore. So overall, the demand environment is starting to improve in most of these places.
Thank you. The next question is from Mugdha Warrior from CNBC TV 18.
Hi everyone, hope you're doing well. Good to see you again. Salil, I want to first ask you about the factors that you've considered for the FY22 guidance. Which sectors is it going to come from? Are you looking at new areas? We had TCS say yesterday that they're looking at disrupting the consulting business. Are you looking at, increasing your addressable market as well? Any new areas that you could look at? And on deal wins, could you explain why there was a sharp decline in the deal wins from the last quarter? Is this the run rate that we can expect going forward in the coming quarters as well? Praveen, of course, there's been a sharp spike in attrition. You've talked about the fact that there is a fall because of the demand. But we did see that TCS has reported an all-time low attrition for the quarter. So what can Infosys do differently? And in FY22, what are the wage hikes that we can expect? Are you going to be hiring more? What are the hiring plans for FY22? And Nilanjan, then are you factoring wage hikes and more hiring in the margin pressure as well?
So thanks. Let me start with the guidance on revenue. I think 12 to 14% growth is an extremely strong guidance and indication that we see very good demand. And we also see that this is coming across a strong foundation from what was achieved in the previous financial year. The demand is coming in a broad-based way. We are seeing almost all of our industries providing a good outlook for demand. So it's not in any one space or the other. The disruption question that you asked, our focus is really on the digital transformation that our clients are driving. And one of the biggest components of that is cloud. As you will recall, we've launched our Infosys Cobalt cloud capability last year. And that is one of the strongest areas that are tracking with our clients for the growth. And of course, there are other components of digital which looks at experience, which relates to how our clients are looking to use the technology in digital. and then data and analytics and cybersecurity. So those are the areas that we are seeing. And with the level of confidence we have, we are saying the growth guidance will be 12% to 14%. In terms of what we are seeing on the deal wins, as Praveen was sharing, large deal wins are typically somewhat volatile in a given quarter, but for a given year, they're quite a good indicator. This last financial year, we had 14 billion of large deal wins. The previous financial year, we had 9 billion. So it's a huge step up on an annual basis. And we see the demand in this financial year to be quite strong, that we will continue to do well with our large deal wins. With that, let me pass it on to Praveen.
And we historically have an average attrition of about 13 to 15%. What we are seeing now at 15% is probably at the high end of average that we have seen, and it's similar to what we saw about 4 quarters back. Obviously, it's higher than what we saw in the previous quarter. And as I mentioned earlier, there are many interventions that we are doing to retain the best of our employees. We have a very compelling value proposition, and with compensation interventions, with promotions, and with many other initiatives that we have in place, we are very confident to sustain around this level going forward, and without compromising on any client requirements. And in terms of hiring, this year we added about close to 21,000 freshers from campus, both in India and overseas. And in the coming year, we are looking at over 25,000, again, both India and overseas.
Yeah, so on Mugdhan, the margins, absolutely the guidance we have factored in the second pay hike from July. And also we've talked about certain headwinds in the latter part of the year with travel, opening up of other overhead costs, which we have squeezed a bit in the last year. And that, of course, both have been factored into the margins. So, but we remain quite comfortable in the 22 to 24 range.
Thank you. The next question is from Poonam Sane from ET Now. Poonam, can you unmute yourself and ask your question?
Yes. Thank you so much for this opportunity. Salil, my question to you is, if I'm looking at the kind of estimates that most of the analysts were working with, especially in terms of the buyback, well, the buyback expectation was 11,000 to 15,000 odd crore. This is the on an average of 12,000 crore was the expectation there. Coming, we have announced a buyback of 9,200 crore. So that is below expectations from an analyst perspective. So any reason for the same, if you could give us more color on the same. Also, I would want to understand that what is the progress in terms of the Daimler deal, while the revenue growth as well as the margin guidance is fairly in line with expectations. We wanted to understand how the Daimler deal would start contributing to the revenues as well as in terms of profitability. And if we could also get more color in terms of the margin trajectory, we would see some of the costs returning. So how would those costs shape up and impact the margin trajectory?
Thanks. Let me start with the buyback. Nilanjan might have some points to add to that, and then Praveen will take the Daimler question back again to Nilanjan for the margin. On the buyback, our approach has been to work with our capital return policy. And our capital return policy has been quite clearly stated a couple of years ago, where we plan to return 85% cash back to shareholders. And there are two components to this, one which relates to dividends, one which relates to possible buybacks. So keeping all those factors in mind, the board decided that this was the amount that made sense. We have a very clear view in terms of how this will support the capital return policy across a 5-year period, and how we'll be able to return 85%, which is our target amount. That's really the rationale for the 9,200 crores that we've announced as the buyback. Let me pass it to Nilanjan first. If there's anything else on the buyback, and then Praveen.
Sure. So just to add to Salil's comment, so if you actually see our payouts of the last 2 years dividend, so we've declared the 6,400 crores of dividend and the 9,200 crores of buyback. Our cumulative payout for FY21 and FY20, which are the first 2 years of the capital allocation policy, we would have paid out 83% of the 85%. So in that sense, I think this is completely in line with our policy, and and that's what the board also considered when deciding the amount of buyback. So I think we're quite transparent and actually working in line with clearly articulated forward-looking policy as well. So that's on the buyback. I think on the margins, quickly to finish that, absolutely, like I said, and we've been talking about it during the last year, that our margin run-up some of them have come from the deferment of costs and the cost deferrals. And we were very, very cognizant of that. And we've been calling that out, that these will become headwinds during FY22. And we factor that into our 22 to 24 guidance. But having said that, this will still be 100 basis points above our pre-COVID guidance, which was last at 21 to 23. So in that sense, this is a step up in our underlying margin trajectory.
On the Daimler program, obviously it's a complex program with many elements. We have started planning for the same. We have started ramping up. We have started getting into details of contracts that we need to novate. We have also started looking at making offers, because there's a rebadging element as well. So a lot of preparatory stuff and other work is going on, and it's going on as per schedule.
Thank you. The next question is from Shilpa Phadnis from the Times of India.
Good evening, gentlemen. Sir, you set yourself a 3-year roadmap to turn around Infosys. What's Infosys's next, especially from a strategic standpoint, when the pandemic has gone from, threat to opportunities to support your clients' transformation agenda? The second question is about how, though cloud adoption is driving a multi-year tech cycle, with the ramp up in cloud deals, how do you see the pricing? Will it only get better? Coming from the recent ISG commentary, they talk about how the cloud ACVs are moderating. So what are some of the specific challenges in terms of acceleration in cloud migrations? My third question is on the deal front. You won a $14 billion TCV, but largely is it on renewals, restructuring? Is there a challenge in terms of the new scope trajectory? If you can help us with this, sir. Thank you.
Thanks for the questions. I'll start off with the first one on our 3-year program and how we look ahead. We think we've had an extremely successful 3-year journey. Some of the elements are how we've really reshaped and become a digital services company. Today, digital is more than 50% of our business. The large deals that you mentioned at 14 billion, but there's also a tremendous amount of work we've done in reskilling all of our employees, in looking at automation and a variety of steps within the company, the way we've transformed to a live enterprise, a complete change in the way Infosys is working with clients and working with employees today. Now, as we look ahead, what we see is a real intense capabilities around digital, and there the main focus remains around cloud, around data and analytics, around cybersecurity. And with the launch of Cobalt, the Infosys Cobalt cloud capability set, we are again in a leading position to work with clients on their cloud journeys. So we feel quite comfortable in the path we've taken and how we're looking ahead in partnering with our clients on their digital transformation journeys. On the large deals, Praveen will elaborate, but one point I wanted to make was with the 14 billion number that you referenced, 66% is net new. So in many ways, that is the driver. Of course, we are also very strong with reviewing what is going on. And those are the factors that are coming into play as we look at the future, the guidance for the future. Let me pass it on to Praveen if you want to add in.
I think as Salil said, the overall out of 14 billion, 66% is net new. And even in Q4, 52% was net new. Last year, when we did the $9 billion of large deal TCV, only about 30% was net new. So this actually varies. I mean, there is there is some volatility in net new, but it's equally important. I mean, we have to win renewals because we can't afford to lose whatever we have presence. At the same time, we also have to capture market share. And that's where the net new comes in. So we have a good balance out there. And I think this year, I think, given that 66% of what we have won is net new, it gives a very, very strong base for growth getting into FY22.
Sir, on the cloud ramp-ups, if you can just help us with that question in terms of the pricing and given the background of the recent ISG commentary on how the cloud ACVs are decelerating. So what are some of the challenges when it comes to cloud migration programs?
So on cloud, the migration work is one part of it. So in the cloud area, and again, ISG also pointed this out, there are multiple facets of the cloud work that we are engaged in or clients are looking at. There is a piece which is on migration, but there is a piece which relates to how clients are adopting public cloud or private cloud. And there's a piece within our COBOL structure which relates to how clients are looking at SaaS providers and rolling out that capability within their ecosystem. Our experience is that actually cloud programs are quite large. And today, what we have seen in financial year 21 within our 14 billion is very strong cloud capability programs that we are working with clients on. So we don't see that scale or size of cloud deals is going to be set. In terms of margins, there are different profiles of different things on the cloud, depending on whether you're working on the public cloud or you're working on SaaS. In general, we do have a view on our digital margin, which is on average higher than the average margin of the company.
Thank you, Shilpa. The next question is from Ayushman Barua from the Mint.
Hi, Salil. Two simple things, actually. So one is as remote working becomes the new norm, right? And as we also gear up maybe for a potential second lockdown. So do you feel the whole concept of on-site working versus offshore is getting redundant as employees can work from anywhere now? How do you plan to deal with that? That's first. Secondly, what's your acquisitions strategy for FY22, given that last year you made a lot of acquisitions? So in which areas would these acquisitions be in the digital cloud space, etc., etc.? Thank you.
So thanks for the questions, Ayushman. The first one relating to work from home. What we've been clear, and I think Praveen shared this during our past earnings calls as well, is to say that first we have a very strong work from home approach that is working really well, thanks to the infrastructure that we built up within the company and the rapid speed at which we moved our people on the workforce. What we've now learned, as you've seen, Nilanjan share the stats, the on-site mix has moved significantly to offshore in the last financial year, much more rapidly than it had done in the previous several years. We think that some of this is the way clients are looking at the business. However, there's also a lot of use and work that we do in our digital centers in Europe, in US, in Australia, and Singapore. And those type of work will continue, even if that becomes a hybrid model, which means partially working from home, partially working from a work location. Having said all of that, we still think that there will be a need to build up some social capital, and some of that will be built when people start to come back to the office. So there are two things at play here, the hybrid model and the shift on the on-site offshore mix. And there are different ways we feel those will play out, and we'll see how that looks in the next few quarters and really in the next few years. On M&A, we will continue with our focus on digital and cloud acquisition opportunities. We will continue to look with the cultural fit, the strategic fit, and of course, price of the asset that we are looking to acquire. With all of those things coming into play, we hope to continue with our M&A activity in this year as well.
Thank you. The next question is from Ayan Pramanik from the Economic Times. Ayan is joining us on audio. Ayan, kindly unmute yourself and ask your question.
Hi. Congratulations, Salil, on a good set of numbers. If I have two small questions actually. So if I look at the attrition number, it seems significantly higher. And we hear that there are some few hundreds of vacant roles across some key clients. So could you please elaborate on that if there are some supply side issues for some key clients? And this, yeah, that's the first question. And second part is if you look at the revenue per employee consolidated, which has grown, which is 55.2 in US dollar thousand. So do you see that improving going forward?
So first, let me start on the question you had about client roles on client projects. We have a tremendous capability on fulfilling demand. We believe that that is going extremely well. As Praveen was sharing some of the points on attrition and what we're doing in terms of real strong employee engagement, there are two factors I also want to highlight. We are making sure that we have huge levels of recruitment both from college campuses in India and outside India, and also laterally. The main reason we are seeing a lot of this focus on Infosys employees is also because our training is probably the best training in the industry, and we are extremely proud of that training. We believe that that's the training that's right for what we want to do in terms of digital programs with our clients. And that's where we are making sure that all of the effort is put in how we are fulfilling all of the work for our clients. In the other question, let me just check, Nilanjan, if you want to address that, please.
Yeah, on the revenue per employee, if you go back in the industry, it's largely been flat, and it's a reflection of two things. There is client pricing, so which is a downward pressure, and the other hand, you start putting in automation, which actually tries to negate some of that client discounts and rate negotiation. So if you see that the secular trend line has largely been flat, but of course, we continue to see drive initiatives like digital pricing, and we know that our digital side of the business is giving us higher margins and higher RPP. But at the same time, there is some downward pressure on the core side of the business, which offsets that. But our intent continues to remain to command, a larger and larger premium for our digital side. But secular trends it's been largely flat as of now as a combined portfolio.
Thank you, Nilanjan. If I taking a cue from that, if I may just ask one question. So, are there still requests from clients for discounts like we had seen last year, March?
Yeah, so that's a continuous process. I don't think we've seen any acceleration, and like we mentioned last year also during COVID, wherever clients had come during that initial period, we were actually happy to extend anything. But now contracts come up for renewals, etc. Clients, come and ask for productivity gain, but nothing unusual. This is quite normal of what we're seeing.
Thank you, Ayan. The next question is from Supriya Roy, who joins us from Tech Circle.
Hi everyone, I hope everyone on the call continues to be safe. I have two quick questions. The first one is to do with, I want to know what's the percentage of salary hikes that's been across what percentages of employees on a total basis, and in the same, how many employees were hired, and among those additional employees who were hired in this particular year, 2021, how many of those were freshers? And again, in the same questions, if you could also just concentrate the percentage terms in terms of which delivery units it was concentrated towards and which geographies it was concentrated towards? And the second question is, firstly, congratulations on the great profit, the great operating margin. Now, in the times to come, we're seeing the landscape change rapidly. So you have it's no more TCS and Infosys going to a client and trying to show them something that they need, but more so Infosys or
Priya,
Infosys.
I'm sorry, your voice is very muffled. We're unable to get any of the questions clearly. No, we can't hear you clearly at all. Gentlemen, are you able to understand the questions?
I could hear the question too clearly. Could you try maybe again or from another audio source maybe?
Yeah, making closer to the device.
It's going up and down.
Yeah, unfortunately, Supriya, the audio is very muffled. If there's time towards the end, we'll come back to you. Otherwise, we'll connect separately.
An email.
Thank you. Thank you. The next question is from Chandra from Money Control.
Thank you. Hope all of you are well and safe. Celine, I know you addressed this consulting question at the beginning, but my question is the way different companies are approaching it seems to be very different. While some of them are taking the acquisition route, others are talking about the organic route in terms of how they will leverage expertise of both the company as well as the client to kind of build out an end-to-end solution. Now, Infosys has tried acquisitions in the past. So what would your own approach be to sort of, upsell IT services? Is this an area that you're looking at seriously? Do you think Infosys can do what a McKinsey or an Accenture are doing today in this area? The other question was for Nilanjan. While a lot of people are talking about the buyback premium, they're talking about a gap up opening for the stock tomorrow. 25% I think is higher than what people were expecting. So what did you factor in while deciding on the buyback price? Praveen, a couple of questions for you. You said that you will look at a number of incentives. Would expanding the ESOP pool be one of them? Because you're also competing with startups and hyperscalers to acquire talent. And why did you put off this second compensation review till July? I mean, shouldn't you have done it perhaps now or next month, considering your attrition is at 15%, your utilization is at 88%. So what would your comfort level be on utilization also going forward? Thank you.
Thanks for your question. Let me start with the first one. I think what we are seeing in the market is with all of the digital work, there is more and more decision making that is in addition to the technology buyers, also the business buyers. What Infosys has done over the years is built a very strong consulting business, as you pointed out, through acquisitions, but also through organic means. And over the last couple of years, our consulting business is performing well and connecting very well with clients across different geographies and industries. So our approach is very much of the view that we need to work with business buyers, make sure that our consulting and technology teams are working hand in hand. If you look at some of the large digital transformation programs we have started in the last year, you take an example of Vanguard, that really is something that looks at business issues and insights which are driven by our consulting team, and also industry needs which are driven by our industry team, and the technology and process operations capabilities, both coming from the tech and BPMs. So it's really bringing all of these things together that's more important in our mind. The one Infosys approach that I referenced at the opening, as opposed to just doing one thing, let's say consulting, or another thing which is industry, or something else on tech. So yes, we see many peers that you referenced doing those sort of things, but we are now well ahead of that. We are in this mode where all of this is integrated as one Infosys and bring that to the client. Let me pass it to Praveen, I think, with respect to the second question.
Yeah. See, on the attrition front, obviously, we had a salary increase of effective January 1st. And so we felt July 1st would be the right thing. And historically also, we have always had a phased approach to compensation increase, and we do it in a staggered manner. And that's something we want to get back to a regular cycle in the coming year as well. And so we felt July would be adequate. And in the interim, as I said earlier, and if there are any other interventions required in terms of retention, we'll be happy to do that, and we are already doing it. And in terms of RSUs, we already for 10 to 15% of our promising people in the middle level, we have already, I mean, it's not something new. In the past few years, we have been issuing RSUs, and that program continues.
On the buyback.
On the price, yeah. Go ahead, Nilanjan.
Nilanjan, you are muted, I think. Nilanjan, you are muted.
Yeah. So on the buyback price, I think first thing is this is an open market buyback, unlike the other buybacks which you have seen in the recent past, which are tender buybacks, where the price is fixed. So our premium of 25%, give or take, versus 1400 is the maximum buyback price. That's number one. So it's not the price at which we'll buy, that's the maximum price, since we'll be buying. This is a more longer drawn process in terms of timing, because firstly, this needs shareholder approval at the AGM, which is on schedule for June, and then there's a longer process during which we'll buy it. So this will go on for the next 6 to 7 months, if not more. And considering both these factors, we think that a maximum price of 1750 is quite fair.
Thank you. The next question is from Shivani Shinde from Business Standard, who joins us on audio. Shivani, please unmute yourself.
Hey, hi. Good evening, gentlemen. I hope I'm audible.
Yes, Shivani, please go ahead.
So a couple of questions have been asked, but let me just get more clarification. So Salil, you, as you know, you just replied, completed 3 years of the entire restructuring plan that you started in April of 2018. Are you happy, or not happy, but yeah, are you happy to see where Infosys is? You've spoken that digital is going to be the focus, going ahead roadmap. Call out three really important aspects in digital that you would want Infi to be ready with. And I'm looking at a roadmap of 5 years. And where do you see Infosys in the next 5 years? Also, please give us a color on the core business aspect, which has been going down. So where do we see that bottoming out? Nilanjan, a hygiene question, FY22 in terms of CAPEX, what do we expect from Infosys? Work from home still continues to be there. So if you could throw a little bit more color on that. And Praveen, a lot of questions asked on salary hikes and attrition. The quantum of hikes, if you could give us, and campus hiring, you said that you're hiring almost similar or slightly more. Are you giving a geography breakup as well? Thank you, gentlemen.
Thanks for those questions. Let me start, Shivani. What we have done over the 3 years, we talked a little bit earlier about, I think, a huge way both within the company and with how we connect with clients on their digital journeys. There's been a huge change there. Now, looking ahead, as you said, on a 5-year horizon, I think the thing really to keep in mind is one of the biggest opportunities in front of us, because our clients are going there, is really the cloud opportunity. And it's very maybe simple to say cloud because it encapsulates a variety of things. And that's part of the reason why we've launched Cobalt. It really goes into a lot of specific elements which relate to different parts of the cloud, whether it is the public cloud, private cloud, of course, in the hybrid environment, all of the SaaS capabilities, and then migrations and cloud native development. Now, these elements, each of them are huge capabilities that we have built up, and we think that this is going to be a significant part of where our clients are driving their digital journeys. And so we think this will become a bigger and bigger part of our work going forward. Another area I would really focus on is data and analytics. It's something that's becoming more and more critical in how that is being developed with our clients in mind. And it's an integral part of what we're doing in our digital transformation work with our clients. So that will become large. There are a couple of other places where we are also making huge inroads, which we will talk more and more about as we go ahead into the next 5 years. But we are well positioned to capture what our clients are looking to drive in their spend and therefore become closer partners with them. With that, let me pass it maybe first Nani on the capex, and then back Praveen with the salary discussion.
Yes. So on capex, as you know, in FY21, pretty much we shut down on our infrastructure capex as everybody was working from home, and in fact repurposed a lot of spend on work from home enablement, which was about laptops, communication, security. Going into next year, some of these in-flight projects we think will start back, and we will continue to focus like on enablement or work from home. So there will be some ramp up of capex versus the prior year, but it will still be below the pre-pandemic levels.
On the compensation, the quantum will be as per the industry norms. Obviously, we will be targeting segments where the attrition is higher. And in terms of campus hires, this year we had 21,000 campus hires, over 19,000 in India and about 2,000 outside India. In the coming year, we are talking about close to 25,000 plus, about 24,000 in India and maybe a couple of thousand outside India.
Thank you. The next question is from Sankalp Phatyal from Reuters News. Sankalp, just unmute yourself, please. Yeah, perfect.
Hi, good evening, everyone. Salil, my question is to you. I mean, whenever you give an upbeat guidance, you say that there is good demand coming in from the clients. And that's one statement that we've heard across the quarters. And it's true because amid the pandemic, such is the demand for digitization. But I was wondering if you could go a little bit granular on that and give me some color in terms of what is it that the clients are exactly demanding? Because again, we've also heard you say that you want to be a partner in the digital transformation of clients. So could you give us a little more color on that, please? And I heard Praveen say that you're going to hire 25,000 people, freshers from India and overseas. I wanted to ask about the change in the US administration and if that's going to have any effect on the visas, the whole working environment for software services exporters like yourselves. Just those two. Thank you.
So thanks for the question. I think to give you some color on the sort of demand we are seeing, today, if you look, we have work which we're doing, for example, in the retail sector, where we are working with clients who are changing what they're doing with how their end customer, the consumer, is connecting with them through different channels for buying products, for connecting with giving feedback on what is going on. Their sales teams are using different channels to connect with the different rep structures. All of this is being built on a cloud ecosystem, and it's also being built with a new set of technology, which requires leverage, whether it's all of our capabilities on cloud. For example, in many cases, we're using new ways, agile ways to build new software, using the experience capabilities of our digital studios to design the way this technology works, or even roll it out across the cloud into usage worldwide at the same time. So that's one example of the type of project, but these are several different per industry, whether you look at insurance business, look at the utilities business, look at the consumer products business, or the banking business. In each of those areas, there are new ways that our clients are looking to connect with their customers to grow their business. And that makes it more and more critical for them to drive these projects faster, because by doing that, they are able to impact their own growth, their own market share, which is where our support comes in. So all of that really translates to a good demand, and that good demand is translating for us to a very strong revenue guidance of 12 to 14%.
Thank you. Go ahead. Sorry, please go ahead.
Yeah. On the visa front, obviously, our strategy is to be less dependent on visas, and this is something we have been embarking on for the past 2-3 years. Today, more than 69% of our US workforce are locals. And so, to that extent, we are less and less dependent on the visa regime. Having said that, the early indications are the Biden administration seems to be much more business friendly, much more immigration friendly. We have seen many of the restrictions introduced by the Trump administration has either been deferred or they have allowed it to lapse. Even the salary increase, one of the amendments around compensation increases, salary increases has also been put off by more than a year. It's early days. We have to remain to be seen. But from an Infosys perspective, we are less and less dependent on visas. We have a fairly robust model and a lot of focus on localization.
Thank you. The next question is from Sarita Rai from Bloomberg.
Good evening, gentlemen. So my first question is to Salil. Salil, you talked this evening about the acceleration towards offshore in your onshore-offshore hybrid model. And you also talked about, digital design studios, the acceleration of cloud, all of which can be served from your offshore centers. I just wondered what is going to happen to your localization plan? What is going to happen to the development centers that you are going to set up in, that you are going to set up in the US especially, and also in Europe? How does the plan change? My second question is about the coming challenges. You talked today about hiring 25,000 people from campuses in the coming year, maybe 26,000, if my math is right, after what Praveen just said. So there's going to be a lot of demand, not just for fresh graduates, of which India produces millions, but also in the middle and the top levels of talent. I wonder if that is going to be a constraint for growth, and if you see any other challenges facing the industry, if you could elaborate on those two things.
Thanks for your question, Sarita. The first one on what we see as the mix, I think what we are starting to see in the last financial year was a big shift on the offshore side with the on-site mix coming down. Having said that, we still have a huge amount of work that we do from our digital centers, from our design studios, from our proximity centers, whether it's in Europe, US, North America, in Canada, or in Asia Pacific, in Australia and Singapore. So those are things which are very much part of what is going on with our clients. Some of that discussion was on if the hybrid model becomes part of our future, even those centers, those digital studios, those digital delivery centers will have hybrid model working, but in those geographies. So two trends are working here, which we see. One is that there is some shift to offshore that we saw in the last year in terms of delivery. And we've shared some of the stats in how the on-site mix has evolved. And the second one is much more hybrid. Wherever the work is going on, hybrid in that sense, work from home, whether it's going on in the European market, the US market, or in the Asia Pacific market. Or of course, when we're doing that in India, whether it's on campus, work from home. Our sense is both of those trends will play out, and we will see how those trends play out. So all of the work we've done in terms of building local delivery centers will help us, but also the fact that we built a capability that can allow our employees to work in this hybrid mode, work from home and work from office, will also help us as we move ahead. In terms of recruitment, as Praveen was sharing, we are looking at in the range of 26,000 campus hires, a couple of thousand which will be outside India, about 24,000 which will be in India. As you pointed out, we have within India a large number of college graduates that we can look at for that recruitment. But of course, there's also a lateral recruitment that we will continue with. in terms of what the constraints could be, we feel that the demand environment is extremely strong. We believe that we have the ability through recruitment, training, fulfill that demand. So today, from our perspective, we see quite a optimistic view of where the market is, where the clients are, and not really so many constraints in how we drive that business.
Thank you. The next question is from Rukmini Rao from Business Today, who joins us on audio.
Thanks, Rishi. So two questions. One, you've been able to add an incremental revenue of 780 plus million in a very difficult year. What would you say Infosys has done differently, given that we've seen your peer add about less than about 150 million in the whole of last year? And two, we also heard them say that the large deals are not coming at great margins. Want to get your thoughts on it to see what the correlation might be with the guidance that you have given for the coming year. Thank you.
So first, I think on the revenue, we are really extremely proud and delighted with the trust of the clients, because we have, as you point out, a 5% growth in this extremely difficult financial year that just completed. And we see that really because the way we have built the capabilities of digital, the way our clients have given us many of those projects. We talked at the start of the year for some consolidation. We've seen that in this last financial year. And there's also been extreme focus on automation and cost capabilities. And there again, we believe we have a leading capability in terms of automation that our clients have really engaged with us. So we see that gain of market share differentiate and position Infosys as the industry-leading growth company in terms of this IT services business worldwide. Now, the way we see what we're seeing on large deals, we see good traction. The large deals really come when clients are looking at very strategic digital transformation programs, which start with business, technology, and operations together, or look at business, technology, and cloud, which drives a lot of that change. We've also shared that in general, our digital margins on average are higher than the company average margins. Of course, we are not specifically looking at large deal margins that we share externally, but our margin guidance is extremely robust, between 22% and 24%. And we feel comfortable with the way the large deals that we've worked on, that we will deliver to that guidance in the coming year.
Thank you. The next question is from Sai Ishwar from The Informist.
Hello. Hi. So one question to you, Salil. TCS in their commentary yesterday had told that they are seeing unusually high demand for smaller deals. So if I go through your numbers, even you've seen a 10-15% increase compared to last year in your $1 million and $10 million brackets. So could you actually tell us, could you actually give us a color on the deal size you're getting, the size of the deals you won till now, and where do you see the smaller deals receding? When do you see it receding? And one question for you, Praveen sir. In the same time last year, we saw a lot of sectors like retail, manufacturing, and travel getting affected because of the pandemic. And right now, globally, I think, at least in India, we're back to square one in terms of the pandemic. So could you give us some color on these sectors which are directly affected by the pandemic? What is your outlook on these sectors? Thank you.
So thanks for those questions. On the first one, we are seeing good demand both for large deals and for mid-sized deals. So we don't see that there is less demand for one or the other. Overall, we see good demand across all of that spectrum. Praveen mentioned the composition of our large deals, the number of the large deals that we have, and it's spread across different size buckets, even in those large deals. What we are seeing today really is based on the capabilities that we have built up, we see good traction for small, medium, and large deals from our client base, and that's helping us to see this very strong outlook for growth for the next year. Let me pass it to Praveen for the other one.
In terms of some of the distressed sectors like retail or manufacturing, I think let me take retail for starters. Obviously, retail was one of the sectors which was majorly impacted by the pandemic. Many of the subsegments of retail continue to be impacted. However, from our perspective, barring the first quarter of last year, in the last 3 quarters, we have seen gradual increase in uptick in demand from a retail segment. We had, in fact, we have ended Q4 with a good performance in retail. So on the back of this increasing performance, as well as some of the net new large deal wins we had in the second half of last year, we feel fairly positive about retail in the coming year. Likewise, in manufacturing, this was again one of the sector which was majorly impacted. They had challenges both on the supply side, constraints, as well as on the demand side. But with the economy opening, we have slowly started seeing some uptick in demand in industrials and to some extent in auto space. Aerospace, we still see softness, and it may take several quarters for it to recover. But again, in this space, we have done extremely well. In fact, one of the largest deal, last quarter we won one of the largest deal in the history of Infosys. So we have industry leading performance in this segment, and we remain very optimistic in the coming year as well in terms of growth and increasing market share. Travel and hospitality again continues to be challenged with multiple waves and so on. So here again, clients, I mean, in general, I think while many sectors are distressed, there is a need for them to invest in technology to build resilience and to increase their connect with consumers and employees in the virtual world. So there, while that is distressed on one hand, there seems to be continued investment on technology on the other hand, and that's something we have started seeing in the travel and hospitality as well, though in a small sense, not as big as what we are seeing in some of the other sectors like financial services.
Thank you. Penultimate question from ET Prime, Joshel Mendonça, who joins us on audio. Joshel, can you unmute yourself?
Hello, sirs. Good evening, and I will stick to one question. We've seen, net new deals in the large deals be 60% this year compared to 30% last year. Have you made changes in how you chase large deals that will account for this kind of massive jump in the net new quantum? And are you expanding the large deals team to, to address the increasing demand we're seeing on the client side?
So, Joshel, thanks for your question. I think we are continuously looking at better ways to connect with our clients. And in that light, every quarter and every year, we make some refinements to how we approach the market. That's part of the ongoing way that our business is evolving, especially on large deals, but in many other areas of the company. In terms of what we are seeing in expansion, there as well, we feel there's good outlook in terms of what we see in the demand. So there's an overall expansion that we are looking on how we build go-to-market capabilities, whether that's for large deals, overall CSG and sales, new account openings, or the account expansion approach. So overall, we feel there's more ways that we will have to connect with clients.
Thank you. We have Supriya's questions online, and in the interest of time, I'm going to quickly read it out to you gentlemen, then we come to the close of this Q&A session. Supriya from Tech Circle has requested us to read out her questions to you. For Praveen, what is the percentage of salary hikes that were offered across bands or levels of employees? Were there particular concentrations in any geographies or a type of delivery units? And how many employees have been hired in 2021 so far? And how much of these were freshers? And for Salil, With rising potential in digital transformation, do we see Infosys' M&A strategy anytime in your tenure as CEO, from capturing foreign market shares to capturing new IPs to drive product innovation beyond what competition will keep adapting towards?
I will start first with the salary hike. We did one salary hike effective January. The quantum was similar to what we have done historically, and the quantum of salary hike also varies from geography. It's different in India, it's different in other geographies, and even within these geographies, we normally tend to have higher compensation increase at lower levels and lower compensation increase at higher levels. So that's something that's what we have really done in the January cycle. Now, in terms of number of hires, this year we have hired about 36,500 people, out of which about 21,000 people are freshers. And I'm talking about FY21.
Thank you, Praveen.
In terms of the M&A, the focus will remain on what we are seeing in the digital space. There is more and more that we are seeing that we can scale up, whether it's on cloud, on cyber security, data and analytics. We're also looking at areas which are related to Internet of Things. We are looking at other parts of our business which can also help us to be part of the digital transformation agenda for our clients, whether that's in the area which relates to business, marketing, to sales, technology, engineering services, and other areas. So those are all the places where we are looking in terms of what we could look for M&A. There is no fixed sort of an approach in terms of geography. We are always looking to see what we can do in services, but where we can have IP that supports that for our clients, we are open to that as well. That primary focus is really on digital and expanding services team.
Thank you, Salil. Thank you, Praveen. And with that, we come to a close of this Q&A session. We thank our leaders. Thank you, Salil. Thank you, Praveen. And thank you, Nilanjan, for joining us today.
Thank you, everyone.
Thank you, our friends from media, for being part of this press conference. Before we conclude, please note that the archived webcast of this press conference will be available on the Infosys website and on our YouTube channel later today. Thank you once again for joining us. Have a fantastic evening.